Hello and welcome everybody. Today we're going to be doing our quarterly eToro popular investor call, and we are joined by some great popular investors today, including our regular panel, as well as some special guests as well that we have from all over the world. Just to say before we get started, the comments of the panel is not financial advice, so please don't take it as financial advice. So I'm going to be introducing the panel now, and I'm going to start off with 𝗏𝗏𝗂𝗏 Can you please introduce yourself?
Yes, I can. My name is 𝗏𝗏𝗂𝗏, and my screen name on eToro is CPHequities, and I'm one of the most copied popular investors on eToro, and I've been investing for 15 years, and before that I was very much into games. I've been playing chess at elite level, and I'm a 4-time Danish Scrabble champion, so I love very much to play games. And actually I found that some of the things you need as an investor are some of the same things that you would need as a good game player. So there are some similarities. So it's like keeping your head cool, having a highly analytical approach, and also having strong pattern recognition skills is something that's useful in game playing, but also in investing. And I'm on eToro. I think I've been there for around 6 or 7 years, and my annual returns are around 17% a year, and my goal is to take my account to $1 million from the $82,000 I have right now. And I think, according to my estimates, that I've set 16 years to perform this task. That's what I'm trying to do, and that's what I hope everyone will follow me in seeing this journey.
Great. Yeah, it's really good to set a long-term goal. Thank you. Thanks very much, Christian. Antonio, could you please introduce yourself?
Sure. So, hi, I'm Antonio. My name on eToro is AntonioNobileC. Recently, I'm probably one of the guys here who's been a popular investor for less time. I only joined the program about 10 months ago. So, yeah, I've been trading. I started trading about 6 years. I'm now trading full-time. I manage my eToro portfolio, I manage my own portfolios, and I write a newsletter called Strictly Macro. And yeah, that's what I do. I trade.
Excellent. Thanks, Antonio, for joining us. And Zach, could you please introduce yourself as well?
Yep, so my name is Zach. I've been on the platform for, let's see, 7 years now, so it's been a while. I've been a popular investor for about the same amount of time. I trade how I trade my life savings. Nothing much more I can say other than that. I just buy whatever I think makes sense. That's kind of it.
Okay, thanks very much, Zach. And then Amar, please introduce yourself.
Hi everyone. So my name on the platform is 𝗏𝗏𝗂𝗏. I've been a popular investor for about 3+ years. I have had a YouTube channel for about 4 years plus, where I manage my life savings, and I'm also trying to grow it to $1 million. So I work as a lawyer in Singapore. I've been investing, or been familiar with investing, for about the last 7 to 8 years.
Okay, thanks very much, Amar. And lastly, I'll introduce myself. My name is Stephen Budgeon, and my username on eToro is 𝗏𝗏𝗂𝗏𝗏. I'm a macro investor. I invest in lots of different asset classes, and I'm a full-time investor. And before that, I was an expatriate management level employee who worked in a number of different industries around the world and in many different countries. So great. So now we've introduced everybody. We're going to kick off with the main topics. And because it's a brand new year, I thought it was really important for us to kind of summarize a little bit about some things that happened in the last quarter, and a bit more of an overview of some of the key areas that happened last year in the market. Of course, it was a very difficult market for most people, and it's really good to get the panel's thoughts on some of the things that happened in the last quarter. So I wanted to start off with Antonio, actually, because obviously seeing your portfolio, and I see that you're quite bearish at the moment on the market, and obviously you were I think for the majority of the second half of the year, if I was correct. Could you just give could you just give some of your reasons why you were obviously bearish on the market, and kind of what things you are looking for like data, etc., to happen before you might become a bit more bullish on things?
Sure. So I actually turned bearish pretty much at the start of last year, right at the beginning. And the key point for me was that due to inflation rising, the Fed obviously was going to be tightening, and I expected growth to slow. I expected earnings to slow. Obviously, we're going against some really tough comparisons. 2021 was a sort of a booming year, so inevitably you were going to slow. And obviously, the Fed hiking and tightening was going to cause that slowdown to be even greater. I think that as we head into 2022, that's going to accelerate from here. But to summarize 2022, I mean, 2022 was the inflation trade and the rate trade in a large part. So inflation rose way more than anybody expected. Rates and yields rose more than anybody expected. The Fed was more hawkish than even the Fed probably expected. And the result of that was the value of bonds declined. Obviously we all know this, but for people at home, it may be useful to recap. As yields rise, the value of bonds decline. Obviously, the lower the yields are, the more sensitive those bonds are to a rise in yields, right? So if you go from 0.5 to 1, the bond value will decline way more than if you go from 2.5 to 3. So last year, yields rose, bonds declined, equities declined in tandem. Number of reasons for that, but in large, at its simplest level, we could say it's sort of the change in the discount rate, so revaluing equities based on new interest rates, the higher cost of capital, the value of cash flows, etc. And the other trade was that the dollar rose. The dollar rose because it's the rate differential spread, right? So the Fed was the most hawkish. They hiked rates the most, more than any other central bank, the quickest, and so the dollar rose faster. Q4 of 2022 was the inversion of that trade. Right, it wasn't the trend. The correlation didn't change, but it inverted in the sense that actually equities and bonds rose in Q4, and the dollar declined. Now, maybe people think, well, what do you mean equities rose in Q4? Well, they actually did. If you look at the Nasdaq, it was flat. But if you look at the S&P, it was up 7%. If you look at the Dow, it was up 13, 14% or something like that. So Q4 was the same trade. It was an inversion, and in my opinion, it's sort of it's the change of the trade, right? We've gone from the inflation trade, which was 2022, to 2023, which maybe will be the earnings recession trade, the earnings decline trade, the growth slowdown trade. And so we're now in that transition phase when the market's sort of figuring out, okay, inflation is no longer the problem. What is the problem?
Okay, thanks. And is there anything you're particularly looking for, any indicators you're looking for before you might become a bit more bullish on the market in your positions?
Sure. Well, I want to see the bear market play out first. In my opinion, the bear market hasn't played out yet. Okay. A lot of what we saw in 2022, in my opinion, was a structural decline in the market due to the interest rate changes. But we didn't see outflows. In fact, 2022 was a record year for flows into equities and ETFs. Value funds had the highest inflows ever. Growth funds had the second highest inflow ever. That's despite, declines of 60 or 70%. So, I mean, first of all, I want to see I don't think growth has bottomed. It's not even an interest rate thing where I want to see the Fed change course, because I don't think the Fed dropping rates from 5 to 4.5 is actually going to change the economic reality, right? I want to see, first of all, I want to see earnings get priced, decline in earnings get priced into the market. I want to see some real fear come to participants and no longer chasing this Fed pivot. I want to see us get beyond that. And then, you know, the market will front run the eventual growth, you know, rebounding growth, right? I expect the market will front run that. But we're not quite there yet. So I want to see, the market needs to price in it. You know, we're now talking about a soft landing. Okay. How soft, how not soft it's going to be, I don't know. But let's price in a decline in earnings. Let's get beyond this Fed pivot narrative. And then we can sort of talk about us bottoming. That's sort of the way I'm looking at it at the moment.
Okay, thank you, Antonio. And Christian, do you have any views on kind of a review of the last quarter in 2022? And also, if you could provide any of your views on interest rates kind of moving forward and inflation, how you expect it could play out.
Yeah, so I think that was a good recap by Antonio. And I think one thing that's interesting is that the market, I'm also in a kind of defensive position based on what happened last year and also what I'm seeing right now. But as Antonio said, the last quarter was different than the other quarters in the sense that S&P rose 7%, but Nasdaq was -1%. Actually, Nasdaq made a kind of a bear market rally of 14%, but then it lost 14% again. So what that told me is that the market actually, even at this point, want to front run the story. So even you know, if we get a recession, we're going to you know, even in the beginning of this recession, if it's just a shallow recession, you will see the market rally at that point. So I think the market is right now, it's actually a little bit too early. We're kind of jumping the gun, maybe also with this rally in the first days of January. But we're seeing that the market wants to get ready to make this rally when the economy turns around, and that, I think that was a sign that we saw in November from the Nasdaq. There was this 14% rally. So I don't think it's time yet to go into the risk on trade, even though it would have been good to do it here in January. I think you need to think about what's coming, and one thing we can see is that unemployment rates are still very low, and I think this means that wage inflation is going to be more sticky, and that may turn out to be a challenge for companies because they're going to pay higher wages to employees for them to stay, and that's going to affect their profits going into 2023. So I think I'm probably a bit more optimistic than Antonio, in the sense like I'm not shorting the market. I'm just staying a little bit defensive. I'm staying very well diversified because I think there's a large range of outcomes that we could see. There is a chance that we don't see a recession, and there's a chance that the recession will only be rather kind of shallow. And in this sense, I think the market is going to be very quick to turn around and rally. I don't think this is the time to go all in on those risky assets, but maybe like in 6 months from now, it's possible that the markets could turn around. And until that time, I stay kind of defensive.
Okay. Thanks, Christian. And do you think that this recent rally over the last few weeks might be because of the US dollar weakening after it kind of peaked a month or two ago, and it's starting to weaken against other currencies?
Yeah, I mean, of course, you have to think about that because of the strong US dollar. Yes, last year you had very weak US markets, but the overall effect was perhaps not as bad as you would see in the charts, because the actual returns you got weren't that bad if you factor in the stronger dollar. But actually, the dollar weakened already in the last part of last year, as far as I remember. So I think what we're seeing now is actually that some analysts are slightly more positive on the outlook of the economy, and also we see China reopening and a few other things. We're getting ready for the Fed to take a slower pace in the interest rate hikes, and also maybe stop in May or something like that. And maybe the market is expecting that there will be rate cuts late this year. So because of this, I think that we have seen some positivity, more positive market. So it's not only related to the US dollar being weakened, I think.
Okay, thanks very much, Christian. And Zach, what are your views on the market? Do you think that this early 2023, the stock market going up in value, do you think it's a little bit too early to tell? Do you think it's a little bit of a fake out? And what are your views overall on the market?
I mean, I think we entered like loony town, right? Like nothing's changed since last year. Like no expectations have changed, and somehow we rally. Like, I mean, come on, guys. Like nothing happened. Like for all the Singapore guys, we all own Chinese stocks. This is like known, right? We all love Chinese stocks. And it just like went up 30%. My BABA went from like 70 to like 110 out of nowhere. It's like they say it's the China reopened, but we got the news first. The market opened and then nothing happened. And then one day it just decided to like blast off and take off, right? So I mean, we're in loony town. Clearly in crypto it's even worse. You're getting even loonier. The FTX blow up was just like a nuclear bomb went off in crypto and we still headed higher. It's like, what on earth is happening? Like nobody knows, man. This is like some insane markets. But I think it's a case where, like Antonio said, we kind of value is kind of doing well. Growth is going to be a bit tricky next coming years, but I think value is going to continue to kind of do well, you know.
Okay, thanks, Zach. Amar, what are your views on the market? Do you fall into the same camp as some of the others? And also, kind of what pockets of opportunities do you see as well going into 2023?
So yeah, I think I probably agree with what Christian has said. I think it's right to be a little defensive at this time. But on the other hand, I mean, I'm a long-term investor, so I have a 3 to 5 year time horizon. So over that period, I expect a lot of the companies I own to definitely go up. Yeah, I think Chinese stocks have rebounded quite strongly. I think one reason for that is maybe the delisting threat for some of the US listed Chinese companies has subsided a bit. I heard that the accounting has gone okay, so that might be cleared, and so that was one objection to Chinese companies listing in the US.
They're letting the auditors in. There was a big conflict about whether they were going to let kind of US based auditors into Chinese companies, but that seems to have been agreed now. Yeah,
that seems successful. Overall, my opinion on Chinese stocks has soured a little after the last 2 years. Jack Ma has lost control of Ant Financial, for example. So, it seems that the Chinese government can decide which companies they want to support and which companies they don't want to support. It might cause their economy to lose out a little, but I think that's the risk they're willing to take. We saw that in the zero COVID policy they had for a few years, but when the market couldn't take it any longer, or the people couldn't take it any longer, they had to overturn that policy. So I think they will continue to rebound a little, but I don't think they will do better than US stocks over the long term. So I'm still very heavily invested in mostly US stocks.
Mm-hmm. Okay. And you mentioned, both Christian and Amar both mentioned that you had turned a little bit more defensive because of what had happened in the market last year and some of the economic factors and data. Christian, would you just be able to explain a little bit about how you repositioned your portfolio with that in mind, that you wanted to have a bit more safety and a bit more of a buffer in your portfolio?
Yeah, I started doing this in the beginning of last year, and actually, we started speaking about high inflation even in 2021. And at that time, I was very heavily invested in the high growth stocks, and things were going well with that, of course, and in 2020-21. And then I saw that some of these stocks were turning around, and especially in November 2021, you saw that a lot of those stocks were losing a lot of value, and I simply exited a lot of those positions, but I took some losses. But I just decided at that point that I wanted a more defensive portfolio. So what I did, and that was in the beginning or in the summer of 2021, I started investing in commodities. because I saw this as a kind of hedge against inflation. That turned out really well. So even if I had some losses on the growth stock, it was a little bit, there was a little bit, compensated somehow for the gains in commodities. So I started spreading into a little bit more commodities. I sold everything that was non-profitable companies, growth companies, almost every one of those companies. I'm ready to jump in again when the right moment is there, but I don't think the moment is there yet. I even invested in US dollars as well to keep a very strong hedge about a recessionary scenario. And that was from the middle of last year, and I exited this position again now because the dollar has really been weakening. But I use different ways of hedging my portfolio against this. And this year actually, I started, or that was in December last year, like 1 month ago, I started buying a few bonds as well, which is also working as a kind of a hedge against a recessionary scenario in the sense that if we see a strong recession play out, then we could expect bonds prices to go higher as yields go lower. And in this sense, I think the bond trade is a great hedge against a recessionary scenario. So at this point, I have a combination of stocks, big tech stocks, I have some bonds, I have commodities, and I try to stay well diversified at this point because I think there's a wide range of outcomes that we could see this year. We could see a recession. It's possible. It's going to be deep. It can be shallow. So there are a great range of possibilities. And for this sense, I think it's important to stay well diversified.
Okay. So you're just you're kind of reacting based upon the specific scenario that happened with putting in some hedges in place.
Yes, I'm doing that. Yes.
Okay. Thanks, Christian. And Zek, I know that you still have some oil-based stocks in your portfolio. What are your views, 2023, about the oil market, and in particular the oil stocks that you own?
I think we don't have enough oil in the world, man. Like I mean, Russia oil is definitely coming back into the market, but it's always been there. Like they're selling to India, they're selling to China. But I just don't think we have enough oil in the world, and we've had years of underinvestment, and that underinvestment is just gonna cause things to just go crazy. One of the positions I had was rig, mainly because like everyone hates offshore mining, but offshore rigging, but what choice do you have? Because you can't explore anymore. But you're gonna get oil, so that's kind of been tricky. But yeah, the ESG movement is making it difficult on people to like kind of get oil out of the ground. So it's gonna get expensive. I mean, that's my sense, but I've been wrong for about like 6 or 8 months, so we'll see how we go from there.
Yeah. And the offshore industry as well, like those contracts for the offshore rigs, they're on contract for a long time, right? So they're on contract for several years.
Oh yeah, we should let the viewers know. Stephen used to work in this industry, so he knows more about this than me. Yeah, you should give your thoughts on that, man.
Used to work in oil and gas, yeah. I think that the oil market obviously surged last year, mainly because of the war between Russia and Ukraine. That went on for, which is still ongoing at the moment, and this caused the oil prices to reach like over 120 at one point. I think that the oil prices have started to come down now, but I expect them to be continue to be slightly elevated. I don't think they will be. They will go back up to those, peak periods last year where it was up over $120. But I think as China, the reopening of China, and there's going to be a bit more demand for oil, I'm expecting oil stocks to do reasonably well this year, but obviously not as well as they did last year. Ammar, are you expecting a soft landing or a more harder landing from the Fed?
My guess is there'll probably be a harder landing because generally the Fed tends to get it wrong. They got it wrong the last time when they said inflation will be transitory. So I think right now they're raising rates at too fast a pace. as well. So my guess is there'll probably be a hard landing. It might not be necessarily bad for stocks. I mean, if the economy shows signs of weakness, the stock market might rally on that because the expectation is the Fed will start cutting interest rates. So the other thing I'll say is that we're already seeing a lot of layoffs, especially in some of the tech companies. Google just announced and they're going to lay off 6% of their workforce yesterday. Microsoft, a very big, stable company as well, is also laying off about 5% of their workforce. So you can already see signs of weakness in the economy. I know the unemployment rate is quite low but I expect it to rise a little at least. So we'll see how it goes, but I think there are probably chances of harder landing.
Okay. All right, thank you. And Antonio, do you have any views on that? Do you look at specific data to look at what decisions you make in selecting stocks?
Sure. So I mean, I agree and disagree with what Amar said, in the sense that I agree that it's likelier to be a hard landing, simply because the Fed always screws it up, right? So if we go on the history of it, that's their track record. In terms of what Amar said of stocks rallying because they expect to pivot, I mean, the real question is it going to be a rally or is it going to be a sustained bull market, right? And if you're going to tell me, yeah, they'll rally because the Fed will pivot, sure. But is that going to issue a sustained bull market? I think that's a different question. I think there's also another issue which people are really need to, which we this year will be figured out, which is what's going to cause the Fed to pivot, right? Okay, so growth is slowing. We've seen, retail sales down a huge amount, industrial production down, manufacturing production down. Inflation is going to come down, right? Simply because the demand is not there. The supply side has caught up and the demand is not there. What do you do when you can't sell your stuff? You lower prices, right? So inflation is going to come down also because you've got these huge base effects that we're going to comp against. So by the time we're in June, we're going to compare against 9% of last year, right? Yeah. So inflation is going to come down. Maybe by the summer, we're down at 3-4%. The question is, and Amar alluded to this, is the Fed was fooled once by transitory. From all of their communication, they don't want to be fooled again by transitory deflation or disinflation, right? Their greatest fear is that we enter a period like the 70s, where inflation just came down and then it went back up again. It came down and it went back up again. So I think they're going to try and stay as tight as possible for as long as possible. So, I mean, we don't know whether they'll end at 5.25. They'll manage. They're signaling they want to do 3 more 25 basis point hike. The market's assuming they'll only manage to do 2 more 25s. I mean, I think that's probably fair. It all depends on the outcomes, right?
Yeah.
And how bad things get. I mean, that's really, I mean, does something break? Then they'll maybe have to cut sooner or they'll have to slow their pace. But I think their pain point and their pain threshold is much higher than it was historically. They're not going to blink at a small thing. It's going to really take something more sustained to cause them to blink.
Yeah. And you also might find that Jerome Powell will want to build a legacy, to say, a little bit like they did in the 70s, to say that they broke inflation. I think Powell is a very different beast than what Yellen was and then what Greenspan was and that Bernanke was. I think his mindset and his forma mentis is very different, and the way he looks at it. Looks at things. We remember when he first came in, he tried to tighten, he tried to raise rate. That was one of the first things he tried to do. So, I mean, he's not a fan of 0% interest rates and infinite QE. Okay, he doesn't support that, in my opinion. And so for him, this is almost an excuse. Of course, the Fed is not only him; it's divided. You've got the vice chairman. Brainard, she's obviously a lot more dovish. But at the end of the day, he's the guy who calls the shots in there. And I think we're seeing a shift in the Fed. And I think also he wants to break the Fed put. I mean, this idea that everybody's there waiting for the Fed to cave because that means the equities go up. I mean, that's something that he wants to break because it also impairs their ability to act in the way that they want to act.
you know, if they have to cut rates, it just makes their life a lot more difficult. So I think they're trying to, you know, break that dependence on sort of Fed liquidity.
Yeah, yeah, and I think that the unemployment rate as well is still very low. Obviously it's not as low as it was a couple of months ago, but it's still on a historic level. It's still pretty low. So I think that the Fed probably feel like they have got some more room to maneuver in terms of increasing the interest rates.
It's just another excuse for them to be able to just keep on going, because we are seeing things in the economy slow in a huge way, right? You look at all the various Fed indicators, right, from the Philly Fed or the New York State manufacturer, they're all cratering to 2008 levels or to 2020 levels, right? You're seeing, you know, the economy is slowing in a major way. But of course, they've got the fact, no, inflation's, interest rates, employment is still 3.5%. So, I mean, we're going to stay tight because inflation is still above 6. And it's an excuse for them, because they also know that the employment is not really reflective of what's really going on in the employment situation, in the sense that we all know it's hard to find a waiter. We all know it's hard to find these kind of people to work at the moment.
Yeah.
But what we're seeing is, you know, lower pay jobs get filled, part-time jobs, you know, get filled, but higher paying jobs, your Google, your Microsoft, your BlackRock, your Goldman Sachs, all these guys, these are firing. And you're talking about, you know, $50,000 wage compared to a $200,000 wage, right? It's a huge difference. And they know this, but obviously, so it just goes to show how much they want to stay tighter for longer.
Yeah.
Whether they'll be able to is a different story.
Yeah. And I also think that the spending hasn't significantly cratered yet either. I think that people are saving less money. I think definitely, as a whole around the world, I think people are actually saving less money, but they're not necessarily spending much less money. And then there might be a point where it gets to it where people are, you know, have less money to spend, and then you start to see that in the economy. But that should start happening within the next couple of months, I would assume.
Yeah, I agree, and I know I'll pass the mic on, but the way people are spending, and another data point that I've been, you know, keeping quite a close eye on is basically through credit cards, right? You're seeing credit spending just go through the roof, and you've seen savings absolutely collapse. Okay, and now there's a big talk about excess savings still being out there, but those excess savings are in the hands of a very few people who are not going to spend. You know, there's only so much you can spend per year, instead of the lower, you know, the middle to lower tier. You know, their inflation has eaten away at their savings, at their spending power, and they're using credit cards to sort of keep up their spending power. And we're now seeing delinquencies on credit cards slowly rise, right? And we're also seeing delinquencies on auto loans slowly rise. So you're seeing all of that's that phase transition sort of we were talking about at the beginning, where we're now moving from, you know, inflation is not the problem, but growth, spending, earnings are going to be sort of the issue we have to handle this year, or at least in the first few quarters of the year.
Yeah. Thank you. Thanks, Antonio. And Zach, do you have any views on the housing market? I know you invested with some home builders for a period of time. I'm not sure if you're still involved in that.
No, man, too hard. Too hard. I just know that, you know, San Francisco is like the prices have like come down 10%, and New York has come down like 0.8. So you can clearly see there's a difference. But other than that, man, it's just too hard. Like Antonio said, I think a lot of people are losing jobs in the big cities. But small cities seem to be holding out fine. So what's gonna happen? I don't know, man. It's too hard.
Yeah. I guess it comes down to those interest rates. The higher that they go, the less likely people are to move out, take on new mortgages, right? Because the rates are higher.
But that's actually kind of where I don't know, because like, when does like refinancing kick in for these guys? Like, how many of them are just like living off their old loans, and you know, they just don't want to go out and change that because of you know, they're still stuck on their old interest rates. What percentage of that?
Yeah, it depends if it's fixed or flexible.
Yeah, I have no idea.
I'll make a point on what Zach just said, which is it depends on the country. So in the US, for example, most mortgages are 30 years, right? So these guys who locked in their mortgages at 2-3%, I mean, they're solid for the next 20 years. And most people did, right, post-COVID. So in the US, it's new buyers which have the issues. Old buyers are sound. But if you look at countries like the UK or Australia or Canada, where most mortgages sort of are 3 years and then they're renegotiated, there's this great chart which I've shared a few times, which is, it just shows the amount of mortgages which have to be refinanced quarter by quarter. And in the UK, you see that the most that have to be refinanced come over the next six months. So you've got an increasing amount of people who are going to have their mortgage payments basically double. In the UK, the same as in Canada, the same as in Australia and other countries. The US are the only really lucky ones who have that fixed mortgage situation.
Yeah, it's gonna be difficult for people if they do not have a fixed mortgage.
But Stephen, 𝗏𝗏 did well, right? 𝗏𝗏 Financial did really well. Like, it popped yesterday on like 20% or something like that.
Yeah,
short squeeze. Long live the
Short
short
squeeze.
squeeze. That's what we've got at the moment. That's cute. That's January of this year, right?
I thought delinquencies were
everywhere.
lower than what we expected for like just specifically for 𝗏𝗏. I don't know. I didn't really look into it.
Yeah, but 𝗏𝗏's involved in all different types of insurance as well, right? So car insurance, some other insurance as well. But yeah, it was had a nice pop yesterday.
Very nice.
Pleased with that. Christian, do you have any areas in 2023 that you're quite bullish on for your portfolio, whether that be sectors or geographical regions? Do you have any kind of thesis that you expect to play out?
I actually started building a bit of a value component of my portfolio, and this is in line with what 𝗏𝗃 said earlier, that I think we're going to see some of the same dynamics, at least of the first half during this year. So I think value stocks are going to do well during this period, and it's probably going to take some time for this to change again back to growth stocks doing well. So I started building up this value part of the portfolio. I also think, like, if you look at the big tech stocks, like they got hit very hard last year, and it's kind of over time, I think there will be some kind of mean reversion for those stocks, because they're going to get out strongly on the other side of a recession. So at some point they're going to get back and overperform the market like they've done over longer periods. And for this reason, I think that if it's not now, in this exact moment, you could start dollar cost averaging into those stocks, and it's going to be, in my opinion, a pretty safe trade over time. I think they're going to come back, and for this reason, I also keep those stocks in my portfolio. And then I'm considering the bond trades that I've made to expand on this position. That's something that I would consider, depending on how rates develop. But I think it's possible that we may have seen the market's expectations for rate peaking, and for this reason, it's probably not such a bad idea to get invested slowly in bonds over this year, I think.
Yeah, that's true. Actually, as those interest rate rises, those bonds become a lot more attractive, right?
Yeah, exactly. Yeah.
And I also find it quite interesting as well, because what you said about value and growth stocks. I saw a chart a couple of days ago comparing the valuations of value stocks compared with growth stocks. And I also saw the one from the previous year. And the one from the previous year in 2021, obviously it was the growth stocks were totally overvalued compared with value stocks. There was a massive gulf in difference. The one I just saw recently for the last year that's just passed, they're closer together, but obviously the growth stocks are still overvalued compared with the value peers. But I think the gulf is starting to shrink.
Yeah, but also I think it's important still, like if you were originally a growth investor, not to lose track of those very strong companies that are growth companies, and that are going to invent beautiful things during this decade and the next decade. We have some great companies in this, and I think it's it would be a mistake to completely throw them out and not invest in them. It's just like a matter of time before some of those companies are going to perform well again. I'm just not ready to jump in because it's really perceived as a risk-on trade, and the problem with this is that many of these companies have high debt. They're not very profitable, and for this reason, it's not the right moment right now. But it will be soon again, I think.
Yeah. Yeah, I think you're right, Christian. I think it's not about you know, being all or nothing, right? I think it's all about kind of the weighting in your portfolio. So the weighting could go up or down depending on the risks in the market at that time. But if you're bullish long term on technology stocks, I think it's prudent to keep some in your portfolio because, as we've seen last year, really anything can happen.
Yeah, true.
In the markets. Just for time purposes, I'm going to move on, and I thought it'd be important to talk a little bit about crypto because obviously crypto had a very tough year in 2022 after kind of a blockbuster 2020, 2021, and saw huge drawdowns the last year or so. Starting to see a little bit of upside, as Zach alluded to over the last couple of weeks. We're now above those levels that we were at before the FTX collapse. And I just wanted to get some views on the panel, whether people think that we might have bottomed in crypto and whether we potentially going into a kind of crypto spring era, not a crypto summer era where everything goes parabolic, but more a crypto spring era where things start to kind of range a little bit more and we start to see some upside. Zach, as you work in the crypto industry, just wanted to get your views on what you think about the crypto market and if you see that there's a potential turning point at the moment.
I mean, yesterday we just had a big day, right? Genesis just filed for bankruptcy, so
yeah,
that's a huge one. The Genesis, for the people who don't know, is owned by DCG, which is Digital Currency Group, and they own the ETF, the Bitcoin ETF. So it's going to be interesting to see what happens here, but I think generally the market I'm seeing a lot more distressed assets than I am like interesting projects right now. Like every memo that comes across my desk now is pretty much distressed. From my understanding, market makers are not back in the market. They are just sitting on the sidelines, kind of waiting, seeing how things go. A lot of funds have actually closed down, like especially those who had money stuck on FTX, they just closed because what can you do? So yeah, I don't think it's crypto summer, spring, anything. It's gonna be a winter. It's gonna be horrible. And it's gonna probably stay cold for quite a while. And yeah, we'll see what happens. I mean, Shanghai is kind of interesting because Ethereum is gonna go into this upgrade. But other than that, I don't see anything that interesting. Polygon is doing a lot of interesting things, so I always recommend holding Polygon. They're into the Disney stuff, they're into this and that, and their business development is just fantastic. So yeah, I would look into Polygon if I was anyone. Other than that, no man, I think it's gonna be cold winter.
Do you think that there's going to be some more fallout from the FTX situation, or do you think that's kind of mostly played out now, or do you see that there's going to be other crypto companies within the ecosystem that could potentially go under in the next?
I don't know who's left, man. Oh god,
there's still quite a few.
Voyager's gone, BlockFi's gone. What else do we have, man? I don't know.
Well, I think Nexo's next.
Yeah,
Nexo is a big one, but they got raided, so we'll see what happens.
Yeah, potentially. I think all the kind of yield providers that have obviously suffered or gone completely under this year, and I think that they were just providing unsustainable returns, and in order to do that, they were taking more and more risks. And obviously, when the market turns pretty sharply, that's when you start to have issues and people start to liquidate, and then you have legal issues, etc.
But that's something that's interesting about that market is that all that did was create leverage in the market. So if you think about what happened with all these, it's pretty much 2008 in crypto. Just over leveraged into an asset that's just headed in one direction. It turns the other way, it just capitulates, right? So we just kind of had a 2008 moment. So well, we'll see. I don't think there's any more leverage coming back into the system, man. Like, where is it going to come from? I don't know.
It will take some time. Yeah, I think it will take some time. It'll be a kind of a natural progression, but in a way, these periods are pretty good because things do get quite frothy during the bull markets.
Mm-hmm.
And when things get frothy, you start to get bad actors, you start to get bad behavior, you start to get over risk. And sometimes these bear markets act as a good way of flushing out the crap.
No, but it's a great point that you brought up. I mean, you can bring it into the panel, put it in the panel. Like yesterday, Genesis filed for bankruptcy, right? But if you look at Bitcoin prices, it went up. So what happened there? I don't know, man. Do you guys have any opinions?
Well, there's not a lot. Well, I'll just answer that quickly. But there's not a lot of Bitcoin that's actually moved over the last few months. I think a lot of the speculators who came into the market when things were frothy, they've already sold, and it's been going up and down, mostly down, but they've had a lot of opportunities to sell, right? I think they've mostly sold, and I think a lot of the funds have repositioned, taken out their risk, their on risk proportion of their funds. So I think that people aren't really selling. I think you're left with some pretty hardcore hodlers, people that aren't selling their Bitcoin.
So what Stephen is saying is no more paper-handed weenie babies, only diamond hands now.
pretty much. Yeah, pretty much. Ammar, do you have any views on the crypto market?
I'm not a heavy crypto investor, but I definitely believe in Ethereum's potential. I believe in the potential of a decentralized world as well. So I like that aspect of Ethereum. Bitcoin, I do my investment in Bitcoin through a company called Block, or formerly known as Square.
Yeah.
They are quite heavy on promoting this kind of decentralized platform.
Yeah. And
they also hold some Bitcoin as well. So these are my two primary investments in the crypto world.
Okay, thanks, Ammar. And Antonio, what are your views on the crypto market? I know that you have some views. I saw that I think in your portfolio, when I looked at it earlier, that you were also shorting some companies in the crypto ecosystem. I can't remember. I think it might have been Coinbase from the top of my memory. Mm-hmm. But quite interested to get your overall views on the crypto market.
Sure. So, I mean, I won't repeat anything that Zach's already said.
Yeah.
I mean, I think he's covered it pretty well. One point I would add on to that is, I mean, in my opinion, we still remain in a crypto bear market, right? And what happens in a bear market is volatility rises. Volatility rises, it means that it expands your possibilities of outcomes on the upside and on the downside. And this applies to all markets. And that's why you have short squeezes. And that's why, in a bull market, you don't have a bull market that crashes 20% every few months. But in a bear market, you have a bear market which rallies 20% every few months, right? And that's simply the volatility. And obviously in crypto, it's like the most volatile asset out there. So you're going to have those range of outcomes is like that. So no, in my opinion, we still remain in a crypto bear market. I mean, crypto's at its simplest is a liquidity trade. And as we see the Fed do QT, and as we see M2 go negative, which has just gone negative year over year for like the first time since I don't know when, I think we're going to still continue to see liquidity come out of the crypto ecosystem. And I don't know, I mean, my best guess is that there's still a few exchanges out there which are going to go belly up. I don't know which ones. I don't have the time to do the research on them specifically, but I would imagine there's one or two still lurking out there, which we'll find out. And Genesis is a big one. I mean, what's happening with Genesis and DTG and Gemini is huge. And I don't think that's fully understood or appreciated yet. I'm bearish on, I mean, I'm sure MicroStrategy, because he's a levered player in the space. simple as that.
Yeah.
And he's tied to Silvergate, and what's going on at Silvergate is kind of you know, dodgy. There's some things going on there which are not so
yeah. Well, MicroStrategy is basically
it's
like,
a Bitcoin.
It's a Bitcoin hedge fund basically. So yeah, it's
and it's a levered and it's still a levered Bitcoin hedge fund.
Correct.
And you know, when you're levered, you get to pain points, and I wouldn't be surprised this market to push them to that pain point. The other one I'm short is Coinbase at the moment, and I mean I've been short Coinbase on and off pretty much all year, and at its simplest level, it's just volumes. Volumes on the exchanges are just down. People aren't trading. You don't have a retail trader anymore, and also I'd expect that over time, you know, Coinbase, even if crypto does, you know, when crypto does resume its uptrend, there's going to be increasing competition, and Coinbase fees are just ridiculous, right? And so, you know, that even in a future bull market, Coinbase is going to have to sort of restructure. You know, well, they're laying off a huge amount of people, but they're going to have to relook at all their fees, which changes all their earnings and all their profiles. So, I mean, I think Coinbase is just a mess, frankly.
Yeah.
Yeah, it was overvalued, and I think it's. I mean, I'm not saying Coinbase is going to go bust or anything like that. I don't think that's going to happen. I think they're probably one of the sound exchanges from that point of view, but I think that earning profile is going to change quite significantly.
Yeah, I think Coinbase are your first onboarding crypto platform where a lot of retail investors first get exposure to Bitcoin and other cryptocurrencies, right? So,
Sure.
and those people are generally the people with the weakest hands, the people that have already sold out of the market. So I think that's really going to affect the volumes during a bear market.
Yeah, I think it's really interesting, actually. I saw WisdomTree, which they make ETFs, right?
Yeah.
And they're launching some tokenized ETFs, which will reflect the value of SPYs and Qs and all those kind of things. And I think that's really an interesting product to be thinking about if you're looking at crypto over the next sort of 10 years, is the tokenization of other asset classes, not as opposed to a token on, you know, a chain which has no value in and of itself, but it's actually an asset which has a value, which has a cash flow, which gets tokenized as a sort of digital, digital token. And WisdomTree is, I see they're doing some work on that, and I'm assuming there's some others we're probably thinking along the same lines.
Yeah, that's interesting. There was a lot of ETFs approved in that 2021 period, albeit futures ETFs. Yeah. I find it, obviously I've been in this looking at this market for a number of years, and I think one of the things about the crypto market at the moment during the bear market is that during a bear market you tend to see that when things are going down, you see that good news, when there's good news in a bear market, it doesn't really go up. You don't see any spikes going up, and when there's bad news, it completely craters, right? Like what happened with a lot of these breakdowns of some of these companies in the crypto ecosystem. And then during the bull market, it's the complete reversal of that. So you see a little tiny bit of good news. You see, 30% pump or something. You know, it's that's just the way it works. And I do think it's fairly positive, or I do expect quite a lot of risk coming up over this in 2023, but I do think it's quite positive that when you are starting to see this bad news now that the price is significantly reduced, that there's a lot less effect on what's happening overall in terms of the crypto prices. And when you are seeing good news now, you are seeing some effect to the upside, whereas you just absolutely weren't 6 months ago. So I think that is a little bit positive moving forward for the crypto market, but I think that there's still a lot of risks in the windscreen mirror. Okay, last topic I just wanted to bring up, and I thought it was really important because it's the beginning of a new year, and I thought it was quite a fun task for us all. and basically that is to come up, each panelist to come up with one bold prediction for 2023. Just before I do that, just to make sure that we stay true and we don't hide away, we made some bold predictions in 2022, which most of them turned out to be wrong. So don't take any of our points as financial advice. But I thought it'd be a really interesting task. I'll just briefly go over some of those things that we predicted in 2022. So we had different panelists on this time last year, and Amar's 2022 prediction was that Elon Musk might leave Tesla, and actually he didn't leave Tesla, but his attention was very much focused, especially at the end of the year, in Twitter.
In a way, he did leave Tesla, right? Because he became CEO of Twitter, so he was, paying more attention to Twitter than Tesla. Not officially, but unofficially, he has left Tesla, I think.
He definitely sold some shares, I can tell you that as well. Yeah, so that was one from Amar. And then we had 𝗑𝗪𝗑𝗪𝗑𝗪𝗑𝗪𝗑𝗪𝗪𝗪𝗪🐂 who was a guest on that day, and he said that Peloton, that he expected Peloton to work on an electric car, which obviously didn't happen. But Peloton have really suffered in 2022. They were one of those growth darlings of the pandemic. And I think he also said that he expected there to kind of be a bull run in tech in the second half of 2022, which didn't happen either. Maverick, who was another panelist, he said that he expected crypto to hit an all-time high in 2022. Also didn't happen. I think everybody was very bullish going into the end of last year. Obviously, things were going up in value, and I think a lot of people got quite euphoric. So obviously that didn't happen. And then Zach said that he expected nuclear energy to be a big focus in 2022, and I think in some ways, although the price didn't the price didn't spike up significantly. I also have nuclear energy in my portfolio as well as Zach. But I think last year there was a lot of new nuclear reactors, new projects being built in all different countries. And I think there was a lot of focus on it because of what happened in Russia, Ukraine, because of the
so we're absolutely correct. We couldn't make any money off of it.
Yeah, but if they're building reactors, etc., then that will quite likely come later, right?
So not yet. We just didn't make money yet.
Timing issue.
We're too early, man.
Yeah, and then my point was, my bold prediction was that I thought that China, actually I was kind of right. So what I said that the US would outperform China in the first half of the year of 2022. And then I expected China to outperform the US in the second half of the year because I expected the reopening a lot earlier in China. Obviously that didn't play out, but actually, I suppose if you look at the indices, look at the Hong Kong versus the NASDAQ and the S&P, I think the Hong Kong indices did slightly outperform, but it wasn't anything to write home about, and it was still a really terrible year for Chinese stocks.
If you included January, we would have been spot on, man.
Yeah.
Can just needed the first week, just the
can
first week.
Can it be a 13 month year?
Yeah, then you would be absolutely correct.
Yeah. Anyway, so those are our points. So again, this is not financial advice. So Christian, can I start with you and have your bold prediction for 2023?
Yes, I think one thing we haven't talked so much about is gold, and I think gold has been pretty strong since November, and it's kind of a momentum trade that I think will be doing quite well into 2023. And actually, I thought about this a few weeks ago, what the prediction would be, and it could be to say a new all-time high, but now it has moved so much, so it's not very bold to say that it will make another all-time high, because it's like only 7%. So I think I will have to predict that it's going to 2,500, and it's because of a lot of dynamics. I think what we saw in 2022 was gold was actually it was not weak if you compare to the euro, for instance, but because it's mostly traded in dollars, it looked like it wasn't doing so well. But against many other currencies, it was actually doing quite well. And now that the dollar is weakening, it's certainly possible that the gold rally we're seeing could continue for quite some time into 2023. So I would say going to 2,500, which is the 30% up from here, is a prediction that I think is not unlikely to happen. And also, I think like you should just to say something. A second thing is like you should keep an eye on the crypto market, because it's very momentum driven, and the momentum we've seen lately. Actually, when I saw it breaking up over 17,000, 18,000 Bitcoin. I got a little bit interested in again, I didn't start to invest more, but it's certainly something to keep an eye on, because we have the Bitcoin halving coming in 2024. And even though people may say it's not really important, and I understand those arguments about that, but what we have seen is like every halving so far has had an effect, and it's just maybe a psychological effect on the market. So I would say maybe not to make a prediction about it, because it's some tough macroeconomic conditions that we have that will probably be problematic for crypto as well. But it's certainly something to keep an market on, because we've seen rallies before those halvings in every other halving, and for this reason it's something that we shouldn't write off totally. So I would just, for me personally, it's like I will keep the Bitcoin, I will keep the crypto I have. I don't think I'm going to be investing more, but I'll just keep it like I've been doing for the last six years, and over time that has been the best way to trade it, I would say, just keeping it.
Yeah, you're right. You're right there, actually, because obviously the Bitcoin halving is coming up in, I think it's May 2024,
Exactly.
and it is a finite supply asset, right? So they're going to be a supply shock of some stature when the Bitcoin halving happened. If we actually look at the market from 2009, which is this part of the halving of the 4-year cycle, actually followed a very similar pattern. It kind of bottomed, the crypto market, Bitcoin bottomed at a very similar time, 12 months after it started to fall. Well, I say bottomed, we don't know if it's exactly bottomed, but bottomed so far. And then in 2009, we did have that spike up from $3,500 to, I think it was around $12,000, if I'm right, before retracing some steps back after that. So yeah, I think you're right. There is a chance that it could play out in a similar fashion. Okay, Antonio, could I have your bold prediction, please?
Sure. So my bold prediction will be that we're going to see volatility spike, and we're going to see the VIX, which is the index of implied volatility on the S&P, probably above 40, maybe above 50, and then once it gets above that, who knows? But I think we'll see a spike above 40 at some point. And it comes from a sort of relatively simple consideration that I suspect at some point, and these events, you don't know when they're going to happen, right? But I suspect at some point we're going to have what I call a liquidity moment, a moment where liquidity is just not going to be there. And I don't know what the driver could be. It could be sort of a credit event, or it could be simply tied to volatility. There's a few drivers. One, we're seeing liquidity, for example, in funds not be there. Look at 𝗣REIT and all various REITs which are not allowing people to withdraw money. That sort of has a cascading effect. So that's one catalyst. The other is obviously the Fed continuing to take liquidity out of the market. And then I think from the volatility point of view, is the key thing is we're seeing huge complacency in the market, right? If you look at indices of sort of tail hedging, so people buying protection out beyond what's 1 week, right? So a month out, 2 months out, 3 months out, it's at all-time lows. It is so cheap to go and buy. I'm not an option expert by any measure, but to go and buy puts and hedges out of the money and out in time is just ridiculously cheap. And so you have a situation whereby at some point everybody might find themselves having to buy that protection all in one go. And when you have a concentration of dealers like you do at the moment, and a lot of speculation in these, 0 dated expiration options, and it just sort of can have. I get the feeling that we can have a credit event which could sort of spark a volatility event, which could sort of spark a brief moment of cascading, panic, let's say. And whether that's in a few months or 3 months or in 6 months, I don't know. And I would suspect that is when you sort of get close to a bottom. If we're going to say, doesn't necessarily have to be the bottom, but I'd suspect that's when we get close to it. I mean, it happens every time. So it happened in 08, so more or less it's not something crazy that I'm predicting. So a spike in volatility driven by a few risks out there happening, sort of converging.
Okay, that's really interesting, Antonio. And do you plan to actually play that volatility and sort of trade that volatility? You use any volatility instruments?
Yeah, it's on eToro. It's a little bit difficult because you've got and maybe if eToro watches this, maybe they'll maybe do something. I don't know. Okay, great.
Please no. We don't need options here. It's too difficult already.
No, not options. I don't know how you'd implement that with copy trading or anything like that. Anyway, they've got the VIX. They've just recently listed the VIX, which is great. But they only list the front month contract, and that's an issue because you can only trade this month, and then obviously there's a time lapse between that contract and the next one, and obviously the next one's already priced higher because it's the next month. And so if they could list, like they did with the oil contracts, 1, 2, or 3 months, or 3 expiries, that would be great. Whereby they list, the front month VIX and the next month VIX, maybe 2 or 3 months, because that allows you a bit more of flexibility in how you're trading it. So yeah, through the VIX, and then obviously I'm net short. So
so you're going to get benefit from that. Yeah. Okay, Ammar, could you give me your bold prediction for 2023?
Yeah, I'm tempted to say that Elon Musk will finally leave Tesla this year, but I'll go with something else.
You have to have a new one. You can't have the same one until it finally goes out.
I'll make another one. I think one mega cap will be broken up this year. So I say mega cap, it could be something other than the big tech companies we are familiar with. It could be even Berkshire Hathaway. If either Warren Buffett or Charlie Munger passes away. I'm not sure how they want to run the new company. Maybe they will break it up into an insurance company, and one will just hold the subsidiaries that they own. That could be one possibility. Or it could be the big tech companies. But I'll be a little bolder. I'll say that I don't think it will be done because of the government. I think it will be voluntary. So probably one of these mega cap companies will do a voluntary divesting. One catalyst could be if the stock price keeps going down, because there's a lot of value trapped in some of these big companies, which are like conglomerates. Basically, they have a lot of valuable assets within them. So they might decide to divest one of their assets. We saw something similar happen with IBM and with Intel in the last few years. So we might see something along the same lines with some of those mega caps.
Okay, thank you, Ammar. And on to you, Zek.
Yeah, so Antonio and Christian, you guys are new. When we say bold, it has to be like out of the park, like absolutely insane. We're gonna have a black star this year who's gonna be one of those old guys who's like, yeah, you guys should invest in like the old economy and like oil and shit like that. He's gonna do really well and he's gonna become a black star. He's gonna be like front and center of eToro. That's my bold prediction.
So your bold prediction is there's going to be a new arrival on eToro,
Yes.
and someone is going to rise to the rank of black star in record time.
In record time, and he's gonna be old, and he's gonna tell us that we should buy like industrials and metals and stuff like that. Like all this tech is nonsense. You know?
Okay, that's a very wild prediction. We're going to call that a wild prediction for 2023.
Except I'm gonna be right, so you guys are gonna like, you know.
Yeah, might actually be right. The wilder you are, the more right you might be. And I'll do my bold prediction. Actually, I should have probably reached out to you and got all your different bold predictions beforehand, because my bold prediction is very similar to Christian's. And I expect gold to do really well this year, and I'm also expecting silver to do very well this year as well. I think kind of gold was quite underappreciated last year. Obviously, the stock market crash, and I think a lot of people thought, well, gold should stand up well to the test, but obviously it didn't. But I think there was some very specific circumstances that played out. I think obviously with what happened in Ukraine and Russia, I think that people expected, well, there's kind of a potential war. I think gold should go up in value, etc. But I think that people knew that that the war would have a specific effect, and it would have, it would be a specific time period between the war starting and the effects it might have on the market. So I think that many people will look to gold as kind of a store of value in 2023. And I think that it's quite likely that gold, Christian predicted 2,500. I predicted a bit less, maybe 2,200, 2,300, but I still think it will perform pretty well. I actually think that silver is quite likely to outperform gold this year. So I guess that can be my bold prediction, that silver outperforms gold in 2023, and I think it's quite likely that silver might push towards kind of $40–45 at some point in 2023. So that's my bold prediction. So thank you very much, everybody. So I think we'll end it there. In the order of time. Thank you very much for joining the Popular Investor Call, and thanks everybody for listening to this video. So thank you all the panelists.
Thank you, Stephen.
Thanks
for having us.
Yeah.
Thank you very much. I really enjoyed that discussion. It was lots of interesting topic areas. So thanks, guys.
Definitely a good one.